There's a question that keeps coming up in the gold and precious metals community, and most people don't even realize they're asking the wrong version of it. They keep asking what's happening with gold. They keep watching gold, they keep tracking gold, and while they're doing that, quietly, methodically, with almost no mainstream fanfare, something is building underneath the surface of the silver market that the most seasoned commodity analysts haven't seen set up this cleanly since 1980. And I want to walk you through exactly what that looks like, why it matters, and why the window to understand this may be shorter than most people think. Let me start by painting a picture. It's 1979. A family in Texas, the Hunt brothers, has been quietly accumulating silver for years. Not just a little silver, not a few coins in a sock drawer. We're talking about hundreds of millions of ounces. They believed, deeply, viscerally, that the dollar was being destroyed by inflation, that precious metals were the only real store of value, and that silver in particular was grotesquely undervalued relative to everything else in the world. They weren't entirely wrong. And over the course of about 12 to 14 months, silver went from around $6 an ounce to nearly $50 an ounce. It was the most violent, most spectacular price move in the history of the silver market. The Hunts didn't engineer that move entirely on their own. They lit a match in a room that was already full of gasoline. The inflation was real, the dollar stress was real, the supply squeeze was real. They just accelerated what the fundamentals were already setting up to do. And then the CFTC changed the rules mid-game. Position limits were imposed, margin calls came cascading down. Silver crashed almost as fast as it had risen. But here's the part people forget. Here's the part that almost nobody talks about when they reference 1980. The conditions that created that explosive environment didn't disappear because of what the Hunt brothers did. The monetary stress, the inflation, the dollar debasement, the supply constraints, those forces continued. And over time, they reasserted themselves. Silver has repeatedly tried to reclaim that territory. It touched $49 in 2011 before being slammed back down. It ran hard in 2020. And now, sitting where we are today, with silver trading in the upper $60 range, with gold above $4,000, and with a gold to silver ratio that has compressed, but still tells a story of silver's relative undervaluation, the setup is beginning to look eerily familiar. Not identical, but familiar. And unlike 1980, this time the demand isn't coming from two brothers in Texas with deep pockets and a conviction trade. This time, the demand is coming from every corner of the industrial world, from governments chasing green energy mandates, from technology companies building the infrastructure of the next economy, from a global manufacturing base that has become structurally dependent on silver in ways that simply didn't exist in 1980. This isn't a speculation story anymore. This is a story about one of the most critical elements on the periodic table running headlong into a supply chain that was never designed to support the world we're building. Let me explain what I mean by that. Silver is not like gold. Gold is almost purely a monetary metal. About 10% of gold demand is industrial. The other 90% is investment, jewelry, and central bank reserves. Silver is different. Silver sits at the intersection of the monetary world and the industrial world. Roughly half of all silver demand, sometimes more, comes from industrial applications. And those applications have been growing at a pace that the mining industry has been completely unable to keep up with. Think about solar panels. Every single solar panel manufactured in the world today requires silver, not in some trace amount you'd barely notice. Each panel uses silver paste in the photovoltaic cells, the part that actually converts sunlight into electricity. As the world has sprinted toward renewable energy, as governments from Europe to Asia to the Americas have mandated solar installation targets that would have seemed absurd just a decade ago, the demand for silver from the solar sector alone has gone parabolic. We're talking about hundreds of millions of ounces per year being consumed just by photovoltaic manufacturing, and that number keeps growing. Then add electric vehicles. Every EV contains silver in its electrical systems, in the charging contacts, in the sensors, in the thermal management systems. As the global vehicle fleet transitions away from combustion engines, every single new car rolling off a production line in China, in Germany, in the United States is pulling silver out of the available supply. And then there's 5G infrastructure. There's artificial intelligence data centers, there's medical devices. Silver is antimicrobial, it's used in wound dressings, in surgical instruments, in a growing array of healthcare applications. There's the defense industry, where silver is embedded in everything from guidance systems to communications equipment. Silver is in your phone, your laptop, your refrigerator, the circuit boards in your car's dashboard, the switches in your home's electrical panel. It is the most electrically conductive element on Earth, and there is no substitute for it in most of these applications. Engineers have spent decades trying to replace silver with copper, with aluminum, with cheaper alternatives. And while copper works for heavy current applications, silver remains irreplaceable at the precision end of the technology stack. Now, before I go further, if you're watching this and you're sitting on retirement savings of $100,000 or more, and you're wondering how any of this connects to protecting what you've spent a lifetime building, I put together a free guide that covers exactly that. It's in the description below. It walks through the saving strategies that thousands of American retirees are quietly using to protect their hard-earned wealth from what's happening in these markets. Worth a look when you finish this video. Back to where we were. Because here's where the story gets genuinely alarming if you're paying attention to supply. Silver is not a metal that you just decide to mine more of. It doesn't work like that. The world's silver doesn't come primarily from dedicated silver mines. Roughly 70 to 75% of all newly mined silver comes as a byproduct of mining other metals: zinc, copper, lead, gold. This means that the silver supply is largely a function of whether the world is mining enough of those other metals. And right now, as commodity analysts have been tracking for years, the pipeline for new major silver deposits coming into production is extremely thin. The lead times from discovery to production for a significant mining project run 10 to 15 years minimum. Environmental permitting alone can eat up half a decade. The silver mines that will be producing 10 years from now are largely mines that should already be in development today. And the exploration data tells a sobering story. There have been years of consecutive supply deficits in silver, meaning the world consumed more silver than it produced, year after year. The industrial machine has been eating into above-ground stockpiles that have been built up over decades, and those stockpiles are not infinite. The most watched metric in this space is registered silver inventory at COMEX, the commodity exchange in New York where silver futures trade. That registered inventory represents silver that is actually vaulted, certified, and available for physical delivery. When traders and institutions look at the ratio of open futures contracts to registered deliverable silver, it tells you something about the pressure building in the physical market. And that pressure has been building. Here's where the 1980 parallel becomes most instructive, and also where it most sharply diverges. In 1980, the Hunt brothers created an artificial squeeze by buying up paper and physical silver simultaneously. When regulators stepped in and forced them to sell, the squeeze collapsed. The artificial element of it was removed and prices crashed. What's being set up right now is not an artificial squeeze. It is a structural deficit driven by genuine end-use demand from industries that are not going to stop making solar panels because silver got more expensive. They'll absorb higher costs up to a point because they have no alternative. The Chinese solar manufacturing industry alone would rewrite its entire business model before it would abandon silver in photovoltaic cells because nothing else provides the same efficiency conversion. So you have inelastic demand that doesn't bend much in response to price, running into a constrained supply. That is not a recipe for a short-term spike and a crash. That is a recipe for a sustained structural repricing. Let me tell you about what happened in the silver market in 2011 because it's the closest modern parallel before the current setup, and it teaches a crucial lesson. Coming out of the 2008 financial crisis, precious metals went on a multi-year run. Gold eventually peaked in September 2011 at around $1,900. But before gold made its high, something extraordinary happened in silver. Between late 2010 and late April 2011, silver ran from around $18 an ounce to nearly $50 an ounce. That's roughly a 170% move in approximately 5 months. People who had been holding silver through years of stagnation suddenly found themselves sitting on life-changing gains. And then, in the span of less than 2 weeks in May 2011, the CME Group, which operates COMEX, raised margin requirements 5 times in 8 trading days. Silver dropped 40% in those 2 weeks. The physical market held far better than the paper market. People who held actual silver, coins, bars, vaulted metal, watched the paper price drop, but retained far more of their wealth than the charts would suggest. That lesson matters enormously for understanding what we may be walking into. The paper silver market, the world of futures contracts, swaps, and synthetic silver exposure traded at COMEX and at the London Bullion Market Association, dwarfs the physical market in terms of daily trading volume. For every ounce of physical silver that trades, there are many multiples of that volume being traded in paper form. Banks and institutions have short positions in silver that represent claims on silver that does not physically exist in the quantities being claimed. This is not a fringe theory. It is documented in the bank participation reports filed with the CFTC, in the positioning data from the Commitments of Traders report. The commercial banks, the entities who sell silver futures as a hedge for their mining clients, have historically held net short positions in silver that are, by any rational measure, enormous relative to the physical supply available. And when the physical demand becomes strong enough, when enough buyers decide they want the actual metal rather than a paper claim on metal, that mismatch becomes a problem. It becomes a very, very large problem. There's a reason that when silver moved in 2020 and again in early 2021, the premium for physical silver over spot price exploded to levels nobody had ever seen before. Online dealers ran out of stock for weeks. Mints had waiting lists stretching months. The Royal Canadian Mint, the Perth Mint, the United States Mint, all of them were rationing silver product because the physical demand had simply overwhelmed the available supply at the prevailing paper price. The paper market said one thing, the real world said something entirely different. Now, pair that structural reality with the macro environment we're operating in right now. Gold has crossed $4,000 and shows no sign of turning around. Central banks around the world, and this is not speculation, this is in their published reserve data, have been buying gold at a pace not seen in decades. They are de-dollarizing. They are diversifying away from U.S. Treasury holdings. They are building up hard asset reserves because whatever their public statements may say, their actions reveal a deep anxiety about the dollar-denominated financial system. The BRICS nations have been openly discussing alternative reserve structures. The weaponization of the dollar through sanctions has accelerated this trend, pushing nations that previously had no particular reason to hold gold to start accumulating it aggressively. And gold's rise is silver's invitation. Historically, silver follows gold with a lag and then dramatically outperforms. When gold breaks to new highs, silver eventually catches up and then surpasses gold's percentage gain. The gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged in the range of 40 to 60 to 1 in modern markets. In antiquity, it was 15 to 1, which roughly matched the natural geological occurrence ratio of the two metals. Right now, with gold above 4,000 and silver in the upper 60s, the ratio sits around 60 to 1, which means silver is still significantly underpriced relative to its historical relationship with gold. If the ratio were to compress back to 40 to 1, still a historically normal level, and gold simply stayed flat at current levels, silver would need to be over $100 an ounce. That is not a prediction. That is arithmetic. Here's something that I think doesn't get nearly enough attention in the broader metals community. The de-dollarization trade has been almost entirely expressed through gold. Central banks are buying gold, sovereign wealth funds are buying gold, high net worth investors seeking refuge from currency debasement are buying gold. Silver has largely been left out of this conversation. And yet, if you think about what drives a country like China or Russia or India to seek alternatives to the dollar, the same forces that make gold attractive make silver attractive. Except silver has the additional layer of being strategically critical for the green energy infrastructure they're also building domestically. China is simultaneously the world's largest producer of solar panels and one of the world's largest consumers of silver. There is an inherent tension in that dynamic that has not yet fully expressed itself in the silver price. This brings me to what I'd call the catch-up trade. Markets have memory, and silver has been under pressure relative to gold for a long time. The investment community's collective attention has been on gold, on Bitcoin, on other inflation hedges. Silver has been the overlooked cousin. And when overlooked assets catch a bid, when they finally get the attention that their fundamentals have warranted, they don't move slowly. They sprint. They sprint because the undervaluation has been building and building, and when the dam breaks, the water doesn't trickle through. It floods. I want to spend a moment here talking directly to you if you're someone who has worked your whole life to build a retirement nest egg and you're watching what's happening in the world with some degree of alarm. The dollar's purchasing power has been eroding for decades, not as a conspiracy theory, but as a documented, measured, empirical fact. The price of groceries, of energy, of healthcare, of housing, everything that a retiree actually spends money on has been rising at a pace that paper savings accounts, that treasury bonds, that traditional fixed income instruments simply cannot keep up with. The real return on a savings account, after you adjust for actual purchasing power erosion, has been negative for years. People don't feel it all at once. They feel it slowly, in the way their dollar buys a little less each year, in the way they quietly adjust their expectations, in the way they look at what a given amount of money used to provide versus what it provides now. Precious metals have historically served as the counter to that erosion. Not perfectly, not without volatility, not without the risk of short-term corrections, but over any meaningful multi-decade time horizon, gold and silver have preserved purchasing power in a way that paper assets simply haven't. And in periods of acute monetary stress, in the stagflation of the 1970s, in the aftermath of 2008, in the inflation shock of the early 2020s, precious metals have not just preserved wealth, they've grown it dramatically. A gold IRA, which allows you to hold physical gold or silver inside a tax-advantaged retirement account, is one way that people with substantial retirement savings have been hedging against exactly the kind of risks we've been discussing: currency debasement, market volatility, geopolitical instability, the potential for a disorderly reset in overvalued financial assets. If you have at least $100,000 in a 401k, IRA, or other retirement account, and you want to understand concretely how this works without any obligation, the free guide in the description is a good starting point. It covers the mechanics, the tax treatment, and the most common questions people have when they're first exploring this. Now let me bring this back to the technical picture, because markets don't just move on fundamentals. They move when the technical structure aligns with the fundamental story. And right now, the silver chart, if you've been watching it, has been building what technicians describe as a multi-year consolidation base. Silver has been carving out higher lows. It has been repeatedly testing resistance levels and holding ground. The volume profile during the consolidation has been constructive, and the comparison to the chart pattern that preceded both the 1980 move and the 2011 move is something that serious technical analysts have been noting publicly for months. The coiling pattern in a commodity market, when price compresses between converging support and resistance over a long period, typically resolves explosively in the direction of the underlying trend. And the underlying trend, driven by every fundamental force we've discussed, is pointing higher. Let me address the bear case, because I think it's important to be honest about it. The bears on silver argue that the energy transition is happening more slowly than projected, that solar demand may peak as technology evolves, that a global recession would compress industrial demand. Those are legitimate concerns. A meaningful global economic contraction would likely pull silver lower in the short term. It did in 2008, briefly and sharply, before silver then rallied over 1,000% over the following 3 years. The deflationary shock argument has merit as a short-term risk, but as a structural argument against silver's long-term repricing, it breaks down because the monetary demand component, the safe haven demand, the inflation hedge demand, the demand from people trying to preserve wealth outside the banking system actually increases during periods of financial stress, often more than offsetting the industrial demand drop. And then there's the mining cost reality. The cost to produce an ounce of silver from the ground, the all-in sustaining cost across the major silver producers, has been rising relentlessly for years. Labor costs, energy costs, equipment costs, environmental compliance costs, they all go one direction. At a certain point, when the market price of silver approaches or falls below the cost of production, mines shut down or reduce output, which creates further supply constraint, which eventually pushes the price back up. Silver has a built-in floor that doesn't exist for financial assets. You can't print silver. You can't conjure it into existence with a keystroke. You have to go into the ground and pull it out, and that process is getting more expensive every year. Here's what I want you to take away from all of this. The 1980 move in silver was not random. It was the explosive resolution of a set of conditions: monetary stress, supply constraints, dollar anxiety, geopolitical tension, and a paper market that had become dangerously disconnected from physical reality that had been building for years. The conditions that exist right now contain almost every one of those elements. The monetary stress is greater than it was in the late 1970s by virtually every measure. The supply constraints are structural and deepening rather than temporary. The paper-to-physical disconnect at COMEX is documented and observable. The geopolitical tension driving de-dollarization is not some distant possibility. It is actively reshaping the global reserve system right now. And on top of all of that, there is a layer of industrial demand in 2026 that simply didn't exist in 1980. A structural, inelastic, technology driven demand that is not going away, regardless of what happens in financial markets. I'm not telling you silver goes straight up tomorrow. Markets don't work that way. There will be corrections, there will be shakeouts, there will be moments where it feels like the thesis is wrong. Those are the moments that historically have sorted out the people who understood what they owned from the people who were just along for the ride. The people who held through the volatility of the 1970s silver bull market were the ones who captured the historic move in 1980. The people who panicked and sold during the 2010 consolidation missed the run to nearly $50 in 2011. What the data is telling us right now, the supply deficit data, the industrial demand trajectory, the gold silver ratio, the COMEX structure, the monetary backdrop, the mining cost curve, is that silver is wound tight. The spring is compressed. And the historical analogy to 1980 isn't nostalgia. It's pattern recognition by people who have spent their careers watching how these markets behave when the conditions converge like this. Pay attention to silver, not because someone on the internet told you to, but because the data tells a story that is getting harder and harder to ignore. If you've watched this far, I want to make you aware of something exclusive. The free guide in the description is available to everyone, but for those of you who watch to the end, if you're an American retiree with at least $100,000 in any retirement account, and you reach out through the guide and mention that you watched till the end, you'll qualify for a complimentary one-on-one educational web conference. No obligation, no pressure, just a personalized conversation about how these market dynamics connect to your specific situation and what options exist for protecting your retirement from the forces we've been discussing today. That offer is only for people who made it to the end of this video, and it's only available to American retirees who meet that threshold. The link is in the description. Don't wait too long.